Hi, I'm Chip Stites, and this is The Laughing Retirement. Today we're going to talk about a not-so-laughing matter. It's called Where the Market Is Today, and how to avoid what for some of you could be a pretty bad drop. Now, why is that? Well, basically, the average retiree or pre-retiree is afraid of three things, according to all the data. Number one is not having saved enough. Number two is running out of money. And number three is losing it in a market drop. Well, if you're within, 5 to 10 years of retirement, you should be protecting your money. So today we're going to talk about an all-weather portfolio. Today we're going to talk about a portfolio that protects itself, if you will. We're going to talk about how I've put together an all-weather portfolio and what it can do for you. So let me screen share here for a second. There we go. Now, avoid a disastrous drop with an all-weather portfolio. Now, right now, the market is awful high. And this is typical. I've seen it in the 70s, 80s, 90s, 2000, 2008, 2022. And every way along the line, I learned. And over time, I have gradually learned to avoid, lessen, dampen the effects of a market drop. And there's a reason for that. Because a guy named Warren Buffett said, rule number one is don't lose money. And I look carefully at the masters and what the masters have said about investing. You see, most of what the financial services industry does is first to make money for themselves. That's why they tell you to trade all the time, because every time you trade, you make money for somebody else. That's why everybody claps at the end of the day on Wall Street, because they made money, regardless of how you did. Is this unusual? No. Should you be terrified? No, I don't think so. But you should have an all-weather portfolio. So let's take a look at that. Right now, the market, to me, is more like a pendulum. It's not a weighing scale. The market swings from this side, overvalued, to that side, undervalued. And I would rather buy things over here at undervalued. And right now, we're way, way over here. We're overvalued. Now, the price-earnings ratio of the Magnificent Seven, that's today's deal. At one time, it was the dot-coms. At another time, it was the Nifty 50. I mean, it's been, at another time, it was electronics. It's been one thing right after another over the decades. And we do the same thing every time. Well, the price-earnings ratio right now with the Magnificent Seven is just under 30. Now, price earnings is a financial phrase. What does it mean? Well, very simply, it's the price of one share of stock divided by the earnings of the company on one share of stock. So if I take the earnings of the company and I divide it into the price of the company, right now, the Magnificent Seven, the average is 30 years. In other words, the number is almost 30. 30, price of the stock divided by the annual earnings of that company on a price on one share of stock. The annual earnings of one share of stock divided into the price of stock tells you how many years it takes for that company to earn enough to justify its price. How many years it takes for that company to earn enough to justify its price. Right now, it's 30. The average for the S&P 500 is usually around 15.7. Today, the S&P 500 is around 27.87 years, almost 28 years. That's overvalued by a long shot. Now, I don't want to buy when something is overvalued because I want to live with what I buy for the rest of my life. I don't want to have to go changing a portfolio and try to figure out what's going to happen. I want a portfolio that pays me whether the portfolio goes up or down or up or down. I don't want to worry about what it does. So what are the major players doing right now? Well, some pundits say we're in a melt up, buy. Some pundits say, listen, it's way too high, sell. don't buy anything. Some people go to the chat rooms and they say, oh, buy this, buy that, buy the other thing. Since you get what you pay for, I never go to a chat room, ever. I've been there, I've looked at them, I've even commented from time to time, but I don't pay any attention to it. Because most of the time, the herd doesn't know what they're doing. As a matter of fact, my mentor told me a long, long time ago, if everybody else is doing it, run the other way. So who are the masters? Well, to me, it's Buffett, David Zweig, insiders, owners of companies, David Bowson, CFA, Dividend Cafe, private equity firms, Dr. Jeremy Siegel, who wrote Stocks for the Long Run, John Bogle, deceased, who wrote the Little Book of Common Sense Investing. He was the founder of Vanguard, and Mark Lichtenfeld, who wrote Get Rich with Dividends. Those are the types of people that I consider masters. Now, what am I doing? Well, I'm staying put. I've basically taken my profits. I've basically sold my gains, and I own them now. Nobody can take them away from me. And I put those gains in cash, I put those gains in gold, and I put those gains in inverse funds. Now, most people, inverse funds are kind of a bad idea. They are funds that go down when the market goes up and up when the market goes down. And right now the market is way high, so I've made small bets, little dinky bets that the market's going to go down. In other words, I'm taking risk off the table. I'm de-risking my portfolio. Now, 6% of my portfolio is in inverse funds. If I add cash to that, that number becomes 10%. If I add gold to that, that number becomes 14%. If I add what I call my offset stocks, which is in the course, that number is 20%. And right now I'm taking about 50% of market risk. Less risk is better over the long run. And I'll show you who says that later on. So what's an all-weather portfolio? Well, it's a portfolio that has less than 0.05% expenses. Very, very low expenses. Why is that? Well, it's because high expense is less return from you. If you're spending a lot of money on 1.5%, 1.25% mutual funds, that's 0.25% or 1.5% that you're not getting. They're taking it. Whether you get it, whether they make money for you or not. It's a portfolio. The all-weather portfolio is a portfolio that pays you for the risk you take. It's a portfolio based on consistency and lower risk. Now, my return year to date is about 14.5%, according to Schwab. And the S&P 500 is 24.33%. So if you looked at that, you'd say, Chip, you're not doing anything. You're doing less than the market. Well, maybe, maybe not. Watch this. If I take my return and I divide it by the return of the S&P 500, I'm getting almost 60% of the return of the S&P 500. That's what I'm getting. Now, I'm taking 50% of market risk, but I'm getting 60% of market return. When most people don't get market return. So for the risk I take, I'm doing more than the market is. Russell 2000's made 13.5% this year, and the Dow Jones has made 16.5% this year. So I'm doing almost that with less risk. Not bad. Now let's see what that amounts to. Let me show you what consistency is and why it has tremendous value and why taking less risk is so important and why having less expenses is so important. In 2022, the S&P was down a little over 18%. In 2023, the S&P made 24.5%. The NASDAQ lost 33.7%, almost 34%, and the next year gained 43%. The Russell lost 21.5%, and then the next year in 2023, it gained 15%. Now, if I take those averages, the S&P averaged 3.24%, the NASDAQ averaged 4.5%, and the Russell 2000 lost almost 1%. My portfolio in 2022 was up 3.83%. In 2023, it was up 0.022%. So my average was 2.02%. And you would say, well, you obviously you came in third. No, not really. Do the numbers. I keep saying this to people. Do the math. Do the dollars. Know exactly what you've got versus the index. If I had $1,000 and I had the S&P 500, by the end of 2022, I'd have $818. By the end of 23, I would have added $201. So I would have a total of $1,020. If I looked at my portfolio at the end of 2022, I had $1,038. My portfolio does better when the market goes down than the market does. And when the market goes up, it makes less than the market goes up. But it doesn't lose money. I worry about losing money. Why is that? Because Warren Buffett said rule number one is don't lose money. The man knows something. It's pretty well known. He's done very well with Berkshire Hathaway, hasn't he? So my portfolio in those 2 years made $1,040 from $1,000. And the S&P 500 did $1,020 from $1,000. You see, consistency has tremendous value. The more you go up and down, the more you stand to lose. Warren Buffett, one of the masters, said, don't lose money. So, should you do anything now? Well, most FAs will say no. Write it out. That's what they are taught. That's what I was taught. That's what financial advisors are taught. You set up the portfolio and you write it out. And you switch funds at some point in time because you think this fund does better than that fund. Bad idea, because you don't know what the fund's going to do next year, regardless of whether it's a 4-star, a 5-star, or 3-star. Because even though Morningstar says past performance is no guarantee of future returns, they're basing their star system on past performance. And they'll admit that. So what can you do? Well, at a minimum, sell your gains. Sell the gains in anything you have. The other thing you can do is sell anything that owns the Magnificent Seven, because they're the stocks that will have a tendency to drop the most. Raise cash and safe holdings up to 20% of your portfolio. Tell your FA to do this today. Buy a little gold, even at today's prices. Buy a little bit. Gold is a store of value. I don't expect to make any money on gold. I expect not to lose money on gold over time. Now, this is where we are today. This market is going to drop. I don't know when. I don't know whether it's 2 weeks from now or 6 weeks from now or 2 months or after the election or next year. I don't have a clue. But I can tell you that this market is overvalued. And I have seen this before. So I want to use an all-weather portfolio. I want to make sure that my portfolio isn't doing this, that my portfolio does that. So you should be trying to make your portfolio safer, especially if you're within 5 to 10 years of retirement, because you don't know what's going to happen in this market, and you want to safeguard your cash. You want to husband your cash, your money, your savings. Because remember, the 3 things that retirees worry about all the time is, number 1, not having enough, number 2, running out of money, and number 3, losing it in a market drop. We got one coming at some point. Right now, we're told, well, the market's going up, it's a melt up. Get in. Maybe not. For Warren Buffett, rule number 1 is don't lose money. So how do you create a portfolio that doesn't lose money? Well, sooner or later, you're going to lose some. Dr. Jeremy Siegel in Stocks for the Long Run, and that's this book right here, and I would suggest you read it. Stocks for the Long Run by Dr. Jeremy Siegel. Historically, value stocks, those with lower PE ratios and higher dividend yields, have superior returns and lower risk than growth stocks. There, pretty clear. John Bogle. I conclude that the high cost of, and this is his testimony before Congress. And if you read his little book on common sense investing, you'll see that he would use 3, 4, maximum 5 indexes. That's it. That's what he would do. I conclude that the high cost of ownership of mutual funds over the long term is likely to confiscate as much as 65% or more of the wealth that retirement plan investors could easily earn. I didn't believe that. I spent 2 years putting together a spreadsheet. What does the average person at 25 make? How much did they save? Et cetera, et cetera, et cetera, et cetera. I'll show you the spreadsheet. If you want to see that spreadsheet, if you want to talk about your expenses with me, you're welcome to do that. Email me at cstites.cs@gmail.com. My conclusion is around 50%, and a little bit higher when you retire because you're not putting money in. My mentor told me early on, if everybody else is doing it, run the other way. Well, the first time I ever took action, I was scared when I did it, was I was managing about $800 million or so. I was in a bank, and I saw that the dot-coms were a problem. I sold every mutual fund that held any dot-coms. And in 2000, my average investor lost about 50% of what the market lost and had it back a little bit earlier. Now, on November 16th, I'm going to have a masterclass. It's going to be about 1 hour long. You will see how I choose stocks and closed-end funds. You will see when I choose to buy. You will see how this avoids the drop. You will see how the process that I use in choosing stocks. And you will see what class members who have done the course that I offer inexpensively, you will see how they've done. Now, at the end, I will take questions for as long as you have questions. I believe my job is to get rid of me so that you can operate on your own, saving 100% of the cost of having someone else do it for you. How much is that? Well, if you have $350,000, 1% for an FA is $3,500. Another 1% for mutual funds is another $3,500. That's $7,000. $7,000 a year for 20 years, put at 5% earnings that you could earn yourself, a very low amount, is $240,000. That's a lot of savings. Why do I do this? I do this because the masters tell you over and over and over again, and here's even Wikipedia. This is what I got out of Wikipedia. Many studies point to value funds investing having outperformed the growth style investing over long periods of time. You look at it recently, you'll find that value outperformed growth in 2000 to 2010, and the growth outperformed value 2010 to 2020. I think you'll go back in this and find that value outperformed growth in this century, in this 10 years, in this decade. My conclusion is the same. I don't worry about my portfolio. And I don't have a lot to do with it. I don't buy and sell and buy and sell. I take some profits from time to time. And I'm not going to run out of money in retirement because my portfolio just pays me. It pays me for the risk I take. And it pays me at a lower tax rate. You see, we don't realize that we're losing money when we use funds and ETFs because individual stocks themselves that are based in the United States are taxed less. So we've got an upcoming masterclass to talk about these things, to show you how I choose investments, how I choose stocks, what's the process that I use. When do I choose to buy? Why do I choose to buy then? What types of stocks do I want? Then I'll show you what the people in class have accomplished. Now, I hope that you'll take this to heart and take a look at it. And if you happen to be one of those people who say, I don't have the time for this, I know a guy, very inexpensively, incidentally. So I hope you will join us on the 16th of November at 11 o'clock Eastern Time. If you'd like to email me with any thoughts, any ideas, please do so. Email info@thelaughingretirement and just say, Chip, I saw your video. I have this question. I wish you well, and I wish you good investing, and I hope that you avoid the drop. Enjoy. I'm Chip Stites, and this is The Laughing Retirement. We'll talk again.